I had it was like my minimum bar, but more than I hoped for. It was perfect for the space. They were very engaged. The Q&A was excellent that Karen Robinson did with me. Everybody was enthusiastic about the picture. You see the step and repeat. We have lots of pictures for that. They're all going to be in the video, and you're going to see those shortly. And I said that one of the things I was going to do was start doing a podcast talking about, or a live stream talking about the companies I was going to invest in. But I thought before I do that, because I'm kind of jumping the gun, that maybe I should answer to you, this audience, about how do you get started. It was one of the questions that came up in the Q&A. Like, what are the first things that you do if you want to be able to consider this? Of course, I want you to buy the book, right? That one right there. Okay, that one right there, depending on which angle you got at. The first one is this one on this side, which is really deep and dense, Inside Secrets to Angel Investing. It is a book. It is a real serious business book. And as they said in the event, the people that were there that had already read it, was that it was, you have to, it's a lot of new concepts, right? Because when you get started investing in entrepreneurs, whether it's crowdfunding or angel investing, there's going to be stuff that you just don't know. You've never even heard of some of these terms. Like, in this book, there is a whole glossary of terms: equity gap, equity financing, exit strategy, expansion stage, the stages of a company, exploding preferred as a type of stock, right? What is fair trade? Family office or single family office, what's that? So when you get into this space, there's gonna be a lot of new terms. Don't freak out. It's just like with anything. And the example that I gave at the event was, anybody can go buy skiing equipment. Anybody can get, equipment and go buy a ticket and go to the top of a mountain and ski down, and they may not break their leg or their neck, and they may be successful at it, but at some point they need to get training to know how to not break a leg. And so part of the training that comes with getting the book, and getting the books are intended to create awareness that this exists, that you have the ability to do it, in some a high level overview of how you go about doing it. And then when you want to really get good at it, you want to be able to ski those moguls, right? And not fall and crash and burn. There's always a risk with every asset class that you're investing in, but you can learn how to avoid the risks with angel investing and with crowdfund investing, and that's what the training is intended to do. So I encourage you to get the books just to figure out, listen to the Compassionate Capitalist Show, tune in, follow me on Instagram or LinkedIn or YouTube so you can get these live streams. And I'm going to break it down in a little bit in the time that I want to spend doing this right now and engaging with you, my future audience, my current audience, is like, so how do you get started? First of all, it's the emotional decision that you're going to commit time and money to learning how to do this and building a portfolio. Because as we said, and the people that were seasoned in the room, that were like millionaires that have invested and created millions of returns on angel investing in the room, agreed. Don't even get started unless you are prepared to make 10 investments. So how do you make 10 investments? Well, the first step is, so you psychologically, you say, yes, I want to do this. And then two, you're going to say, I want to learn how to do this because my money is important to me and I want to grow it. And I was talking to a lady yesterday and earlier today about, these different, and reason why I chose Jane as my character in this is that there's so many women that have no idea that they have the ability to do this. And so many people in general, I was reading an article about millennials and Gen Zs and Gen Xers that feel hopeless in a way because they feel shut out of the wealth journey, right? Real estate's too expensive, stocks are so volatile, and they want to find a way to have investment with impact, make money with impact, right? And so the first step is awareness. That's the goal of the books, the podcasts, and these live streams. The second step is deciding, yes, I want to start gaining skills at doing this. And then the third step is figuring out how much money do I have to invest? And how would I go along continuing to invest on that. So I'm going to use an example of real estate. Okay, in real estate, you have right now, like the way people are kind of rolling with this. You save up money to buy a piece of property as a rental property, a primary residence that somebody is going to live in and going to pay you rent for. That's the sort of the normal thing that people are kind of get involved in. I want to have a bunch of rental properties that I make money on for my retirement. And so if you do sort of the math on that, you might have to save up 50 grand to be able to buy a $300,000 house. If you're looking at under $300,000 in most markets, you're out somewhere in the boonies, tiny house, not in great condition, right? Which also means you don't get to charge a lot of rent, right, for that, because you got to go where the market will bear, and what is the market going to do for that. So you say you got 50 grand and it's got to have some fixing up. It's going to be 30,000 to fix it up so it's rentable. So you might have 80 in. The days of being able to buy a $200,000 house for a $60,000 foreclosure are gone. They don't exist, because the institutional money that came into the market as a result of the 2017 tax thing for the opportunity zones had a ripple effect that put a lot of institutional money in buying property sight unseen, cash offers 20% more than asked, so there would not be an auction or anything like that. They just buy them, and then they either sit on them or they got enough deep pockets to fix them up, and when the market changes or there's enough scarcity as there is right now, they can charge higher rents. Okay, that's part of that game. But you and me, as regular and individual investors, are priced out of that game. We don't have $250,000 to put into a house in Atlanta, inside the perimeter that's, within the MARTA to get to downtown, that doesn't have floorboards and doesn't have plumbing and doesn't have, refrigerators and doesn't have anything that normally would be required if you were going to get a mortgage on a house, right? If you're going to have the bank help you buy it. And so that's what was the nature, that's the nature of the scoop up of properties in Atlanta, and people are sitting on it. Now rents are way high, people can't buy houses. That's the nature of the real estate problem that we have. So if you do that math, you put $80,000 into this house that you have like $150,000, $200,000 mortgage on at the minimum, right? And so you're paying $2,000 or so a month, and that you might rent it for $2,500, okay? So you're every month you're paying a mortgage. If you took half that money, this is what Jane does in the book. She takes half the money that she saved up for real estate, and she puts it into 10 companies, or starts to build an angel profitability blueprint of 10 companies or 10 investments. And then from that, she knows that she was going to be paying this mortgage. So she's going to take the same amount that she would be paying for the mortgage, or something a little less, and every month after she builds her portfolio, put it into another company. Because one of the things that came out is that you got not a minimum of 10, but you've got to continue to grow your portfolio to diversify and mitigate your risk. And at the end of the book, I use the example of comparing it to a 401k, that as a new person in a corporate gig, or somebody in corporate might be putting $500 a month into a 401k. Well, $500 a month into a Reg CF company is great till you get to a point that you might want to put $2,000 into a Reg A plus, or you accumulate enough assets or enough income, $200,000 as an individual, to be considered an accredited investor, and you can go at bigger amounts. Right? You don't want to go as big as a regular angel of 25K into something, but you could put 2,500 into a Reg A plus that's about to exit. So that's figuring out how much, right? I have tools that you get when you get into the Compassionless Academy to help you figure that out. And then you figure out what you know. What is it that you know? In the case of Jane, she's a nurse. She knows healthcare. She's a grandmother. She has a little baby grandbaby, right? But she knows stuff that mothers know, right? And she also knows stuff that you can do. She has hobbies. She's an outdoor enthusiast. So she starts looking for solutions for things that she wished there were products for. And she's in healthcare, and she knows there's these common problems in the healthcare market that she wants to find a solution for, that she sees in her job. See, so there's earned knowledge things that that you have earned, you earn the knowledge because of what you do in your daily life, and learn knowledge that you went to school for. And a lot of us went to school for something that we don't work in that field. And depending on your age, you have a lot more experience and knowledge than you probably give yourself credit for. So there's a process as you go through to grade what your knowledge is by industry, and you create a profile that you can use to screen a deal so that you don't make the other big mistake that investors make. And everybody, those millionaires in the room all said the same thing. They all said, oh, like I've done that. We've all invested on emotion. And so you put the two kisses of death, there's more kisses of death, but the two kisses of death of getting started investing in entrepreneurs is only doing 3, not committing to do at least 10. 3 and done. I'll see how it works out. Okay. And investing on emotion. So creating, part of how I built this was to create a process to help new investors avoid investing on emotion, or if they are going to invest on emotion, they're making a conscious decision that I want to invest in that. And in the book, Jane does that. She says, okay, this one only hit a 5 score, but I really, really want to see it succeed. So she puts a little money in and watches them so that then she can go and add more money if they do what they say they're going to do with that money. That's what I call the West Coast philosophy. That's the way a lot of the Y Combinator and a lot of them do. They put a little money in, see how they do through incubators and accelerators, and then they follow on invest. And then the other, so that's their industry. So what did I say? That is, yes, I'm going to do this. Yes, I'm going to take some time to learn how to do it. I'm going to commit time and money. And then, so then I'm going to figure out how much money. And then I'm going to figure out what I know. And then I'm going to figure out what do I want, what problems do I want to solve? Oh, she wants to solve a problem in healthcare. So she looks for solutions like that. And once you find somebody doing what you're doing, what you want, what you're interested in, the thing you have a passion about, and they have a passion. This is where the compassionate capitalist comes from, right? I have a passion to solve this problem. There's a company solving it. Then you go find other companies that are trying to solve it in a different way. So you can be the shark to decide which company is solving it or offering it in a way that you're most interested in. And then you decide to invest in that one or watch it, depending on. Now, the thing with crowdfunding is they all have a limited time to raise capital. So you have to be aware. I missed out on an investment that I wanted to invest in. My Panda is the name of the company. I do a shout out to Tamara out there that, you know, it is a utility that busy people, a lot of women that are women executives or women, you know, you got to walk the dog and pick up the dry cleaning and pick up, you know, get this done or that done. And you hire your personal assistants, okay, to help you be better in life. And it's like a crowdsource, like an Uber for people that will do those things, will walk your dog. And then they go in when they're available to walk a dog and they'll click on, yeah, I'll walk your dog. And everybody's certified and checked out and all that kind of stuff. And it's a really great app. And I missed the window because I didn't earmark it, right? I knew her. And so part of the process when you're watching deals is you go put a little heart on it. You like follow it. And then when they give updates, you get them in your email box, and I wouldn't have missed it. And so I'm going to have to wait till the next round, and she's going to be worth more money there, and the stock is going to be more expensive. That's the reason why you get in earlier to add on later, you know. And so that, you know, so what I will be doing as I go through this, so then the Angel Profitability Blueprint, let me say that. It is for these 10 companies, this first initial 10, I like to look for 3 that are income producing to start with, because then you get out, and in the case of Jane, she only did 2, but she's still looking for the 3rd that's income producing. And I will be highlighting some of those as I go through and evaluate, because I'm going to take my own medicine and build my portfolio out. And so they're giving you a fixed return interest on some type of, where they're pulling their money, and usually it's tied to real estate. And it's got some kind of income on it that they're paying you back. Sometimes 12%, 15%. There's a couple that I'm looking at right now. And I have to go into a deeper dive. And you're going to do that with me. Okay, so that's why you got to follow this so you would know when I go live. Because I was going to do it at 4 o'clock, but I got a client call that I'm helping to raise capital that I have to be on at 4 o'clock, right? And so I said, I'm just going to jump on now and do this earlier. So anyway, so that's part of it. And that thing that I'm building out with this community-based ecosystem is for small businesses, meat and potato businesses, to be able to expand and tap their customers and the members of their community, whether it's in their chamber, their church, or wherever, to invest in there and do a revenue share until they get 50% back on their money or whatever works for the numbers, right? You kind of have to judge what that is based on your audience of investors when you're raising capital. And then you get to look at it and say, oh, if I get 50% back on my money, that's a lot better. You know, I trust this company. I've looked at the numbers. I believe they're going to use the money the way that they say it's going to produce the results. And therefore, I'm comfortable doing a revenue share. And so that is something that pays you out on a monthly or quarterly. It just depends on the terms that the entrepreneur has set up. But it's something that makes you feel comfortable that it works. So psychologically, you can be patient in finding those that have the potential big win because they're solving a problem that you care about. And so this is, regular angel investors don't think this way. They get invited, they're just in. This is for the person that is uncomfortable with big investments, not really sure about things, and want to build they're going to be very methodical in how they build out their portfolio and being very methodical as they build their wealth to leap the wealth gap, right? We're leaping the wealth gap because we're accelerating your ability to participate in asset classes that were not part of your ecosystem before. They were not, they're a whole generation. My mom's generation was not allowed to be able to get a loan in her own name, to buy a house, to start a business, to do anything. She had to have a man. I didn't know this at the time, but my uncle helped her buy the house that we lived in when I was a teenager. And so those are the kind of things that, we don't really understand why there is this wealth gap. Well, that's part of the wealth gap. That's part of the reason why. And so you have to figure out a strategy. You cannot save your way to wealth. If you want financial independence, the ability to retire early or comfortably, you need to figure out how to put your money to work with impact. And I believe, with investors that are building something big, that are very passionate, working harder than anybody to succeed because they want to succeed for themselves, and your money is the fuel. Your money is the fuel that lets the car run and lets them go on and do something else. And that happens at all different kinds of stages of a business where they need money to bridge the gap till the revenue gets up, either to invest in order to get the revenue or to pay their people until the revenue comes in to pay the people or pay the things. They have a gap, and investors fill that gap and share in their success as those companies win and as they succeed. And it's a lot less risky than being the actual entrepreneur itself, because build a business takes so much time. I'm in that seat right now. I literally invited, I don't even want to say because I don't want to make it public, but how much effort I put in to get to my 60 that showed up was really a lot of effort. And so every business takes a lot of time, effort, energy, money to get going. If you're the investor, it's just the money. And you can always make more money. It's replaceable. Time is not replaceable. And you can share in the success of dozens of businesses at different stages, different industries, different types of offering. That's what I teach in the Annual Profitability Blueprint. And that's it. This is it. Over and out. Have a great Friday, everybody. Onwards and upwards. See you next time. Thank you. Thank you for tuning in.